Imagine sitting down in front of a game you've played your whole life. You know the rules. You know what's supposed to happen when you press a button, when you take a risk, when you fail. But one day, by accident or curiosity, you discover something the designers never intended you to find. A flaw buried deep in the code. A sequence of actions that bypasses effort entirely. You press a button and gold appears. You press it again and more gold appears. There's no danger, no randomness, no chance of losing. It isn't skill. It isn't intelligence. It's exploitation. You're no longer playing the game as it was meant to be played. You're farming it. At first it feels unreal. You test it again just to be sure. Gold keeps appearing. Your balance grows so fast it stops feeling like numbers and starts feeling like abstraction. Then you imagine what happens next. Surely the administrators will notice. Surely they will shut it down. Surely they will wipe your account clean and ban you permanently. But that's not what happens. Instead, you get a message. Calm. Professional. Almost friendly. They acknowledge that you found something you shouldn't have. They see the mountain of wealth you accumulated, and then they make an offer. Not punishment, not justice. A deal. Give us a small percentage of what you made and you can keep going. You hesitate for half a second, then you agree. Of course you agree. Because this isn't a fine, it's permission. It's a license. It's the cost of doing business, and once you pay it, you go right back to pressing the button. That story sounds absurd, almost childish, like something out of a sci-fi novel or a gamer forum. But it isn't fiction. It is an almost perfect metaphor for how one of the largest financial institutions on Earth operated for years inside the global precious metals market. The bank was JP Morgan, the market was gold and silver, and the glitch was a trading technique called spoofing. This isn't rumor or speculation. This isn't a theory whispered on message boards. It is documented history, confirmed by federal prosecutors, admitted by the bank itself, and quietly absorbed by a system that chose stability over justice. To understand how deep this goes, you have to start with what actually happened, not what people think happened. On September 29, 2020, the United States Department of Justice released a statement that should have shattered public trust in financial markets. The language was blunt. JP Morgan Chase and Commerce agreed to pay $920 million in connection with schemes to defraud precious metals markets. The word defraud matters. Fraud implies intent. It implies planning. It implies knowledge. This was not a mistake. This was not a misunderstanding. It was a strategy. The bank admitted that over a period of roughly 8 years, its traders engaged in tens of thousands of unlawful trades across gold, silver, platinum, and palladium futures. 8 years. Think about that timeline. That's not a bad week. That's not a rogue month. That's nearly a decade of systematic behavior. 8 years of fake orders placed and canceled. 8 years of prices nudged, smashed, capped, and steered. 8 years of other market participants making decisions based on information that was deliberately false. The FBI didn't mince words either. A senior official stated publicly that JP Morgan and its employees plotted to unlawfully manipulate markets and defraud those who traded in them. That sentence alone dismantles the comforting myth that markets are neutral, mechanical, and fair. The largest bank in the United States, an institution entrusted with enormous responsibility, was caught rigging the price of assets it helped control. And yet, here we are, years later, and the bank still trades. It still clears metals. It still acts as custodian for massive pools of physical silver. It is still embedded at the heart of the system. That raises an uncomfortable question. If the crime was real, if the evidence was overwhelming, if the admission was explicit, why did the machine continue to operate? The answer begins with understanding scale. When most people hear $920 million fine, they instinctively feel that justice has been served. Nearly $1 billion sounds enormous in everyday life. It would ruin an individual. It would end a small company. But in institutional finance, numbers only have meaning relative to revenue and profit. Over the 8-year period covered by the investigation, JP Morgan's precious metals desk generated billions of dollars. Traders and analysts who have studied the flows estimate that the profits linked directly to manipulative strategies could easily reach into the tens of billions. Run the math slowly. If a bank extracts $100 billion over time by distorting a market and then pays $1 billion when caught, the outcome isn't punishment. It's a 1% tax. It's an after-the-fact toll. The fine becomes just another expense, another line item, absorbed and forgotten. It doesn't discourage the behavior. It validates it. It sends a message that the reward vastly outweighs the risk. And who actually paid that fine? Not the executives who oversaw the operation, not the leadership that benefited from the results, not the institution as a living entity. The cost was borne by shareholders. A few individual traders were charged, mostly mid-level figures, while the structure that enabled them remained intact. The machine survived, which meant the glitch survived too. To understand why spoofing was so powerful, you have to understand how markets are supposed to work and how easily that process can be corrupted. In a normal market, Price is discovered through real supply meeting real demand. Buyers and sellers place orders they intend to execute. The order book reflects genuine interest. Spoofing destroys that assumption. Picture the futures market as a ladder of prices. On one side are bids, buyers willing to purchase at various levels. On the other side are offers, sellers willing to sell. When you look at this data, whether on a professional terminal or a retail trading app, you assume those orders represent reality. You assume someone actually wants to buy or sell at those levels. Spoofing exploits that trust. Imagine silver trading around $25. Momentum is building. Buyers are stepping in. Price is rising. Now imagine an algorithm suddenly placing an enormous sell order just above the market, representing tens of millions of ounces. The market sees it instantly. Traders react. They assume supply has overwhelmed demand. They cancel buy orders. They sell preemptively. They front-run what they believe is a massive seller. The price drops rapidly. Then, just as quickly, the huge sell order disappears. It was never meant to execute. It was a bluff, a hologram. Once the price has fallen to the desired level, the algorithm quietly buys real contracts at the lower price. The bank didn't sell silver to push the price down. It pretended to sell silver. That's the core of the crime. This all happens in milliseconds. By the time a human could react, the order is gone. The damage is done. Stop losses have been triggered. Positions have been liquidated. Retail traders are out, confused and angry, wondering what just happened. They don't know they were trading against a ghost. The power of spoofing comes from information asymmetry. The bank knows which orders are real and which are fake. Everyone else doesn't. The Department of Justice confirmed that thousands of visible orders were deliberate lies. That means the price discovery mechanism itself was compromised. If supply is fake, price is fake. The market becomes a simulation designed to extract wealth from participants who believe the screen reflects reality. This explains the infamous flash crashes in silver and gold. Sudden vertical drops with no news, no macro trigger, no explanation. They aren't organic moves. They are engineered events designed to harvest liquidity. The price collapses, stops are hit, volume explodes, and then the market recovers as if nothing happened. It wasn't volatility, it was farming. So the crime is clear. The mechanics are clear. The admission is clear. What isn't clear to most people is why the response was so gentle. Why didn't the government shut the desk down? Why didn't it revoke licenses? Why wasn't the institution dismantled? Part of the answer lies in the concept of systemic importance. JP Morgan isn't just a bank. It is a pillar of the global financial system. Prosecuting it criminally at the parent level could trigger panic, credit freezes, and cascading failures. Regulators fear that outcome more than they fear injustice, so they invented a compromise. The deferred prosecution agreement. Under this arrangement, the bank pays a fine, admits wrongdoing, promises cooperation, and avoids criminal prosecution. On paper, it looks like accountability. In reality, it is probation without teeth. The institution continues operating. The behavior may pause temporarily, but the structure remains. This arrangement creates a disturbing incentive. When regulators fine institutions for illegal profits, they are effectively sharing in the proceeds. The government takes a cut. The public, the actual victims, receive little or nothing. Enforcement becomes revenue. Shutting the bank down would end that revenue stream, so the game continues. But money alone doesn't fully explain the leniency. There is a deeper issue that sits beneath gold and silver specifically. These metals are not just commodities. They are monetary rivals. They don't depend on central banks. They can't be printed. Historically, they have acted as a report card on currency management. When gold and silver rise sharply, they signal inflation, debasement, and loss of confidence. For a government whose power rests on the dominance of its currency, that signal is dangerous. This isn't new. In the 1960s, the United States openly suppressed the price of gold through the London Gold Pool to protect the dollar. That effort eventually failed, but the logic never disappeared. It evolved. Today, suppression doesn't happen through direct government sales. It happens through intermediaries. Bullion banks sell enormous volumes of paper contracts to absorb demand. They cap rallies. They manage perception. From this perspective, JP Morgan wasn't just breaking rules, it was performing a function. It was helping maintain the illusion of stability. Seen through that lens, the DOJ settlement looks different. The bank wasn't treated like a rogue criminal. It was treated like a partner that got too obvious. You don't imprison your own enforcer. You fine them and tell them to be more discreet. This relationship becomes even more troubling when you consider JP Morgan's role as custodian for massive pools of physical silver, including the largest silver ETF in the world. The same institution that influences paper prices also controls vast amounts of physical supply. That is a staggering conflict of interest. It's like letting the dealer play at the table while counting the chips. The DOJ focused on futures market spoofing, but it didn't interrogate the physical side. It didn't ask how custody information might be used. It didn't ask whether physical metal was leased, rehypothecated, or used to backstop paper positions. By allowing the bank to remain custodian, The government effectively endorsed this structure. The culture revealed in chat logs made the situation even worse. Traders joked about crushing rivals. They boasted about their ability to move markets. This wasn't a secret operation run by one bad actor. It was institutional knowledge, passed down, normalized. Manipulation wasn't a side effect, it was the business model. For years, this model worked because no one wanted delivery. Paper contracts were traded for profit. Physical metal stayed in vaults. The same ounce could be sold dozens of times. It was a fractional reserve system masquerading as a commodity market. Then something changed. Industrial demand surged. Solar panels, electronics, electric vehicles, national stockpiling. Suddenly, buyers wanted metal, not cash settlement. They stood for delivery. Vaults began to drain. The assumptions that made the paper system stable began to fail. This is where the story shifts from greed to survival. In the past, suppression was about profit. Today, it's about avoiding collapse. Banks built enormous short positions, assuming delivery would never be demanded. Now they face exposure, measured not in millions, but in hundreds of millions of ounces. A short position carries unlimited risk. If silver rises sharply, losses explode. A $10 move against a massive short position can mean billions in losses. At a certain price level, the bank becomes insolvent. That level becomes a line in the sand, a ceiling that cannot be crossed. This changes everything. Spoofing is no longer used to scalp profits. It's used to prevent prices from reaching the kill zone. The algorithms don't just want the price lower, they need it lower. Every rally threatens survival. The irony is brutal. By keeping prices artificially low, banks encourage more physical demand. They subsidize buyers. The cheaper silver becomes on paper, the faster vaults empty. The strategy that once generated infinite profits now accelerates destruction. It's a doom loop. Regulators see this. They understand the exposure. Forcing honest price discovery would cause a violent repricing and potential bank failures. So they tolerate manipulation because the alternative is worse. Stability, even fake stability, becomes the priority. But stability built on fiction always collapses. You can print currency. You can print contracts. You cannot print silver. When physical supply reaches critical levels, the paper market breaks. Delivery fails. Contracts are settled in cash. Force majeure clauses are invoked. Investors receive fiat instead of metal at outdated prices. The real market moves elsewhere, to refineries, manufacturers, and physical exchanges. Premiums replace spot. The screen price becomes irrelevant. This is how suppression ends. Not with an announcement, but with irrelevance. And that brings the story full circle. The infinite money glitch worked for decades because no one questioned it. When people stopped trusting the screen and started demanding reality, the code began to fail. The final lesson is simple and uncomfortable. The system is rigged. The fines are fees. The regulators are captured. But rigging has limits. You can cheat people. You can cheat laws. You cannot cheat physics. In the end, the glitch doesn't save the player. It destroys the game.